you don't realize how bad it will get. I do not say that to frighten you for the sake of a headline. I say it because I have spent the last several weeks reading forecasts written by economists, insurers, and federal agencies who are not trying to entertain you the way I am. They are trying to warn people who will never watch a video like this one, and their language is dry and careful and buried in PDF reports nobody reads, past the executive summary. And underneath that dry language is a single unmistakable thread. Every major institution tracking the American economy right now is quietly telling you the same thing in different words. What you are living through is not the bottom. It is the beginning of the decline. The heating bill you dreaded last winter was the cheap version. The grocery total that made you wince was the discount price. What is coming this winter and into next year has already been calculated, already been forecast, already been priced into models most Americans will never see until the number lands in their own mailbox. Right now, you are paying the cheapest winter heating bill you will ever pay again in your life, and you do not know it because the National Energy Assistance Directors Association just quietly confirmed that this winter will cost the average American household $995, a 9.2% jump from last year. And that number is only the beginning of a curve that goes nowhere but up. Sit with that heating bill for a second before you pay it, because right now, this exact winter is the cheapest one remaining to you. Not because prices are about to spike from some temporary shock that will pass the way a cold snap passes, because the structural forces pushing your energy bill upward are permanent, compounding, and already locked into place years in advance. The National Energy Assistance Directors Association confirmed that the average American household will spend approximately $995 on home heating this winter, a 9.2% increase over last year. And the Century Foundation separately documented that average monthly utility costs have already climbed to $265, up 12% in a single year. And neither of those numbers accounts for what is actually driving the increase, which almost nobody watching their thermostat understands. Artificial intelligence data centers are consuming electricity at a scale the American grid was never built to absorb, and every megawatt those centers pull is a megawatt bid away from your home at a price your utility passes directly onto your bill. At the same time, growing natural gas exports overseas are tightening domestic supply, because the same gas that used to heat your house cheaply because it had nowhere else to go now competes on a global market where a buyer in Tokyo or Rotterdam can outbid your local utility for the exact molecules that were supposed to warm your living room. And unlike a gas price spike at the pump which fades in a few months once the underlying shock passes, the Roosevelt Institute explicitly warned that these are longer-term price increases, not the kind that freak drivers out and fade, because household energy costs, once they climb, rarely fall back down. They ratchet. And they are ratcheting during the exact same window when climate change is separately raising the cost of maintaining and hardening the transmission infrastructure that gets power to your home in the first place. Meaning the delivery charge on your bill, not just the energy charge, is also structurally rising and will keep rising for the rest of the decade. So when you open that bill this winter and feel the wince, understand what you are actually looking at. You are looking at the floor. Next winter's bill is already being modeled higher than this one, driven by the same AI infrastructure build-out that is being celebrated in every earnings call and stock market headline you scroll past, funded in part by the exact price increase currently landing in your mailbox. The number will not stabilize. It will not correct. It will climb every single year for the foreseeable future. And almost nobody explaining the AI boom to you on the news is explaining that you are the one quietly financing it, one heating bill at a time, for a house that is getting colder and more expensive to keep warm every single year you live in it. The jobs report you keep hearing described as stable is not stable at all. It is a statistical illusion built on a collapsing denominator, and Brookings just quietly confirmed that healthy job growth in America could fall to zero or turn negative by 2027, which means the floor beneath your career is not just thinning, it is about to disappear entirely. You have probably heard someone say the unemployment rate looks fine, only ticking up a little, nothing to panic about, and that reassurance is built on a number that no longer means what you think it means. Brookings, one of the most respected economic research institutions in the country, published an analysis explaining exactly why the jobs picture looks nothing like recent history, and the explanation should genuinely unsettle you. Average monthly employment growth has collapsed to just 17,000 jobs since April, a level that historically would signal a labor market already in crisis, and yet the unemployment rate has barely moved, creating an apparent contradiction that is actually a warning sign disguised as good news. The reason the contradiction exists is that the dramatic decline in immigration has fundamentally shrunk the size of the labor force itself, meaning the economy now needs far fewer new jobs each month just to maintain the same balance it used to maintain with hundreds of thousands of new positions. In other words, the number is not stable because the economy is healthy. The number is stable because the pool of people competing for jobs is shrinking underneath it. And Brookings' own published analysis with economists Tara Watson and Stan Voiger estimates that this sustainable pace of healthy job growth could fall to zero or even turn negative by 2027. Zero or negative. From one of the most cited economic research institutions in the country, not a fringe blog, not a doomsday newsletter. And layered directly on top of that collapsing foundation is the AI factor that almost nobody discusses honestly. Because Stanford's own Economic Policy Research Center noted plainly that AI, which has had minimal impact on labor demand so far, could begin to weigh on hiring, and more subtly, that optimism about AI could act as a drag on the labor market if it simply gives CEOs greater confidence or cover. To reduce headcount, they were already looking for a reason to cut. You do not need the AI to actually replace your job for it to destroy your job. You only need your CEO to believe it eventually will, which gives them permission to eliminate your position now and blame the technology later. And KPMG's senior economist described the full convergence bluntly: an escalating Middle East war, pushing fuel and fertilizer costs higher, inflation stuck above target for a fifth consecutive year, a labor market that is weakening in real time, and a Federal Reserve that is effectively sidelined and unable to cut its way out of the problem without reigniting the inflation it has spent years fighting. Bankrate's own survey of the nation's top economists found a more than 1 in 3 chance of a U.S. recession within the next 12 months. Not a fringe prediction, a 1 in 3 chance from the people whose entire job is measuring exactly this. The floor beneath your paycheck is not solid. It was never as solid as the headline number told you it was, and the people who study it for a living are now telling you, as plainly as their profession allows them to, that it is about to give way entirely. A woman outside Atlanta just watched her health insurance premium triple in a single month, from $162 to $483, and she is not an outlier or a worst-case scenario. She is the new median, and 5 million Americans have already made the same discovery you are about to make. Her name is Nancy Linder. She lives outside Atlanta, she is 47 years old, and until this year she paid $162 a month for a health insurance plan she and her husband bought through the ACA marketplace, a plan they have relied on since 2019, after his corporate job was outsourced overseas. That $162 is now $483, nearly $3,900 more per year against a household income of roughly $30,000, which means health insurance alone now consumes almost 20% of everything this family earns in a year. And Nancy is not a cautionary tale from a policy report. She is the median. KFFF, the most cited nonpartisan health policy research organization in the country, confirmed that the more than 20 million Americans who were receiving enhanced premium subsidies saw their premiums increase by 114% on average in a single year, jumping from $888 annually to $904 annually, the moment those enhanced subsidies lapsed at the end of 2025. A 114% increase is not inflation. It is not a bad renewal cycle. It is the removal of a financial floor that 22 million people had been standing on since the pandemic, pulled away in one legislative decision, landing on households that had already built their entire monthly budget around the number that just doubled underneath them. And the fallout is not theoretical. It is already measured. Federal data released this year confirmed that at least 5 million Americans have already dropped their ACA coverage entirely since the subsidies lapsed. And the Urban Institute projects the final total will approach 4.8 million newly uninsured people once the full-year numbers settle, a 21% increase in the country's uninsured population in a single year. 8 states, Georgia, Louisiana, Mississippi, Oregon, South Carolina, Tennessee, Texas, and West Virginia, are projected to lose more than half their subsidized marketplace enrollment entirely. And here is the mechanism almost nobody explains clearly. The reason this problem does not stay contained to the people who dropped coverage. Insurers themselves have publicly stated in filings to state regulators that a meaningful share of their 2026 rate increases, some running as high as 26%, is driven specifically by their expectation that younger, healthier people will simply exit the risk pool now that the subsidy is gone, leaving behind an insurance pool that is disproportionately older and sicker, which drives premiums even higher for everyone who remains, which pushes even more healthy people out, which drives premiums higher again. Harvard Health Policy Chair Meredith Rosenthal called this dynamic by its real name, a death spiral. Not a metaphor, a journalist invented for a headline, the literal term health economists use to describe an insurance market that is actively unwinding itself in real time, one dropped policy at a time. And the people still hanging on are making the exact calculation Nancy Linder is making right now, staring at a number nearly tripled from what it was 12 months ago, in a market that every actuary studying it agrees is about to get more expensive, not less, for as long as this policy remains unchanged. Every retirement account in America is currently sitting inside the same bet, whether the person who owns it knows it or not, when multiple institutions, including the New York Times and ING, are now openly warning that the AI stock bubble, propping up your 401k, could collapse in a way that erases years of savings in a matter of weeks. Open your 401k statement right now if you have one, and look at how much of your future is quietly riding on 5 or 6 technology companies whose valuations have been inflated by a single unproven bet about artificial intelligence. You did not choose this concentration deliberately. Your target date retirement fund, the one you set on autopilot years ago and stopped checking, because that is exactly what every financial advisor told you to do, has been steadily accumulating exposure to the exact same handful of AI-driven megacap stocks that now make up a historically unprecedented share of the entire S&P 500. The New York Times published a warning in October 2025 with a headline that used the word bubble without hedging, without softening, stating plainly that stock valuations are running far ahead of underlying fundamentals in a way that has historically preceded sharp corrections. And ING's global economics team, in their formal risk assessment for 2026, laid out the mechanism with a precision that should genuinely unsettle anyone who has not looked closely at their own retirement statement. If U.S. tech companies fail to monetize the artificial intelligence spending they have poured hundreds of billions of dollars into, questioning the entire logic behind the immense hardware and software investment currently propping up the stock market, tech stocks crash, and that crash hits hardest the very people who can least afford to absorb it, because ING specifically identified that it is the top 20% of American earners who own the overwhelming majority of U.S. equities held domestically. And a crash there does not stay contained to Wall Street executives. It ripples immediately into consumer spending, because that top 20% has been enabling growth in the broader economy for the past several years, even as the bottom 60% of Americans have been quietly struggling underneath them, meaning a stock crash removes the last engine keeping consumption afloat, while the majority of the country was already financially exhausted. And ING's own modeling states the second-order effect explicitly. If AI investment falls abruptly, it would weigh on the construction and investment activity that has contributed roughly 1 full percentage point to U.S. economic growth in the past year alone. And ING concludes this would be enough on its own to push the American jobs market into what they describe, without euphemism, as a full-blown recession. This is not a fringe theory circulating on an obscure trading forum. This is the formal risk scenario published by one of Europe's largest financial institutions, sitting directly alongside their base case forecasts, treated as a real and quantifiable possibility for the year you are currently living through. And the cruelest part of the mechanism is timing. If this bubble bursts, it will not politely wait until you are ready to retire. It will hit whenever it hits, and the people closest to retirement age right now, the ones with the least amount of working years remaining to rebuild what a crash would erase, are precisely the demographic holding the largest dollar amount concentrated in exactly the kind of equity exposure that a correction like this would destroy first and worst. The Federal Reserve Chair, whose independence has kept your mortgage rate and your savings account from becoming a political weapon, loses his job in May 2026, and the president has already told you exactly what he plans to do the moment that independence disappears. There is a single date sitting on the calendar in May 2026 that almost nobody outside financial media is tracking closely, and it may end up mattering more to your daily life than any single headline about tariffs or layoffs or the war overseas. Jerome Powell's term as chair of the Federal Reserve expires that month, and President Trump has not been subtle, has not been diplomatic, and has not left any ambiguity about what he intends to do with the institution once his own appointee takes the seat. He has stated unequivocally, repeatedly, for appeal in public, that his nominee will need to enact his agenda of sharply lowering interest rates, a demand that has nothing to do with the Federal Reserve's actual dual mandate of controlling inflation and maximizing employment, and everything to do with converting what has functioned for decades as a politically independent institution into an extension of the executive branch's short-term economic preferences. And the reason this independence exists in the first place, the reason economists across the political spectrum have spent generations defending it, is that a central bank forced to cut rates for political convenience rather than economic necessity does not produce a healthier economy. It produces exactly the kind of runaway inflation that erodes the value of every dollar in your savings account while you sleep, the kind that a truly independent Fed exists specifically to prevent. And this threat is arriving at the single worst possible moment in the economic cycle to test it. Because the Fed right now is already, in the words of KPMG's own senior economist, effectively sidelined, caught between inflation that has remained above the central bank's 2% target for a fifth consecutive year and a labor market that is simultaneously weakening in real time, a genuine dual crisis where cutting rates to help the job market risks reigniting the inflation still burning through your grocery bill, and holding rates to fight inflation risks accelerating the layoffs already spreading across every sector. A truly independent Fed, insulated from political pressure, is the only mechanism capable of navigating that narrow path with any credibility at all. And that mechanism is scheduled to disappear in May, replaced by a chair whose primary qualification, according to the president who will appoint him, is a willingness to cut rates on command regardless of what the inflation data or the employment data actually says. Layer this directly on top of the debt trajectory. Nobody in Washington wants to say out loud in plain language. A national debt exceeding $39 trillion, annual interest payments that have already crossed $1 trillion for the first time in American history, and a Social Security trust fund that the program's own trustees now say will exhaust its reserves by 2033, 7 years from now, forcing automatic benefit cuts unless Congress acts. And you are looking at a fiscal and monetary system approaching multiple structural breaking points simultaneously, with the one institution historically designed to manage that kind of crisis responsibly about to be handed to someone whose primary job qualification is political loyalty rather than economic judgment. A congressional committee has officially used the words full-scale financial crisis to describe what is happening to home insurance in America, and 7 out of 12 major insurers have already abandoned California while Farmers Insurance walked away from 100, with 000 Florida customers in a single decision, which means the asset you call your home may soon be an asset nobody will agree to protect. Read that phrase again, slowly, because it did not come from a blogger or a doomsday channel. It came from a congressional committee, in an official report, describing the American home insurance market using the exact language reserved for describing 2008, a full-scale financial crisis. Not a rough patch, not a temporary correction. A crisis with the potential to mirror the housing collapse that gutted this country's middle class less than 2 decades ago, except this time the trigger is not a mortgage instrument nobody understood. It is fire, flood, hurricane, and hail, arriving with a frequency and severity that has broken the actuarial math insurance companies have relied on for a century. 7 of California's 12 major home insurance carriers have already left the state, or drastically reduced coverage since 2022, according to the California Public Policy Institute and State Farm. The single largest home insurer in the state stopped writing new policies entirely in 2023, and has been quietly non-renewing thousands of existing ones ever since. In Florida, Farmers Insurance did not reduce coverage. It walked away completely, leaving 100,000 Florida customers to scramble for replacement coverage in a market where premiums already average $15,000 a year, the highest in the nation. And this is not confined to the coasts the way most people assume. The Levy Economics Institute at Bard College documented that severe convective storms, hail and high wind events in states like Minnesota that nobody associates with climate catastrophe are now causing annual cumulative losses on par with a single major hurricane, meaning the crisis is not a Florida problem or a California problem. It is becoming a national one, state by state, storm by storm. And here is the part almost nobody explains until it is too late for them personally. Nearly half of recent homebuyers and sellers surveyed encountered a problem with home insurance during their transaction, and 21% said the deal fell through entirely because of it, according to a 2026 industry analysis. In Louisiana, 30 to 40% of mortgage loan applications are now failing specifically because of insurance costs, not credit scores, not down payments, insurance. And First Street's own risk modeling estimates that 39 million American homes are currently insured at a price that does not remotely reflect the actual physical risk those homes face, meaning tens of millions of families believe they are protected right now, holding a policy number that means nothing against the disaster their home is statistically likely to experience. Former California Insurance Commissioner Dave Jones did not soften his warning when he said the country is marching steadily toward an uninsurable future, and the Joint Economic Committee's own analysis spelled out the mechanism in language stripped of any comfort. If insurance becomes unavailable or unaffordable at scale, it does not just hurt individual homeowners. It threatens to collapse property values across entire communities because a home that cannot be insured is a home that cannot be sold, cannot be mortgaged, and cannot be rebuilt if disaster strikes it. Which means the single largest financial asset most American families own is quietly becoming worth exactly what a bank or a buyer is willing to risk without a safety net underneath it. The federal government did not cut your safety net all at once, because a single dramatic cut would have made headlines and provoked outrage. It scheduled the cuts to land gradually, quietly, program by program, across 2026, so that by the time you feel all of them at once, nobody will be able to point to a single day when it happened. There was no single announcement, no dramatic press conference, no moment you could point to and say that is the day the safety net disappeared. Instead, Brookings' own economic analysis for 2026 confirmed something far more clinical and far more dangerous. That legislation enacted in 2025 made deep cuts and major structural changes to Medicaid, the Affordable Care Act marketplaces, and SNAP, with several of the most consequential provisions deliberately scheduled to take effect on staggered dates throughout 2026 rather than all at once. This is not an accident of bureaucratic timing. It is a structural feature of how difficult cuts get implemented in modern American politics, spread across enough months and enough separate policy categories that no single news cycle ever captures the full scope of what is happening, and no single moment produces the kind of unified public reaction that a one-time announcement would generate. LIHEAP, the federal program that has helped low-income households afford heating and cooling for decades, was eliminated for 6 million households, landing precisely as ENIATA confirms this winter's heating costs are rising 9.2%, meaning the exact families who most need help absorbing that increase lost their assistance. In the same calendar year, the bill got bigger. SNAP work requirements were simultaneously expanded to cover all adults aged 18 to 64, mandating 80 hours per month of documented work, volunteering, or job training, with every previous exemption stripped away entirely, including exemptions that had protected veterans, homeless individuals, and former foster youth for years under both parties. And Medicaid work requirements, passed in the same legislative package, are scheduled to take effect specifically in 2027, meaning the group of Americans currently breathing a temporary sigh of relief because their coverage has not changed yet are on a countdown clock that started the moment the bill was signed, with the deadline arriving quietly, without fanfare, right as the ACA marketplace collapse from expiring subsidies is still working its way through the system. Brookings itself, in its own official language, states plainly that it will be watching how these policies are implemented and how they impact health coverage, food insecurity, and financial hardship throughout the year, which is institutional language for we do not yet know exactly how bad this will get, but we know it is designed to get worse before anyone fully understands what happened. And Capstone, the global analyst firm that tracks exactly this kind of policy impact for institutional investors, has separately warned that the SNAP cuts alone will hit grocery stores and food manufacturers hard, because SNAP dollars represent a significant and irreplaceable revenue stream for retailers in low-income areas, meaning this is not merely a story about individual families losing benefits. It is the quiet removal of a financial floor from an entire tier of the American retail economy. Time to compound with rising heating costs, collapsing health insurance, a weakening labor market, and a food supply already strained by drought and fertilizer shortages, none of which was scheduled by accident, and all of which lands on the same calendar within the same 12 months. Every single crisis I have shown you in this video was not designed to arrive separately. Lay the dates side by side on a single calendar and you will see something that should genuinely terrify you. All of it lands in the same 6-month window, starting this fall and compounding through the following winter. Stop thinking about each crisis in this video as its own isolated story, because that is exactly how the institutions publishing these warnings present them, each in a separate report, each written by a separate team of economists, focused on a separate sector, none of them required to connect the timeline to the report sitting on the desk next to theirs. But you are not an economist writing a sector-specific forecast. You are a person who has to pay all of these bills out of the same single paycheck, on the same calendar, in the same 12 months, and when you actually lay every date from this video side by side, the picture that emerges is not a series of separate problems. It is a single converging wall, arriving in a single compressed window. This winter, heating costs climbed 9.2% to an average of $995, landing on households that simultaneously lost LIHEAP assistance entirely. During that same winter, ACA marketplace enrollees who did not drop coverage are absorbing premiums that have already more than doubled, a 114% average increase that took effect January 1st and is not reversing. Throughout this same period, UANA recipients aged 18 to 64 are navigating a brand new 80-hour monthly work requirement with zero exemptions, a bureaucratic burden that Brookings and food policy researchers both warn will push people off benefits not because they do not qualify, but because they cannot navigate the paperwork fast enough to keep up. Layered directly on top of that same calendar, the labor market Brookings describes as producing just 17,000 jobs a month, a level that historically signals a labor market already in crisis, continues weakening into a year where healthy job growth could hit zero or turn negative by 2027, according to Brookings' own modeling. Layered on top of that, Jerome Powell's Federal Reserve independence expires in May 2026, opening the door to the exact kind of politically motivated rate decisions that KPMG's senior economist warns could reignite inflation at the precise moment the labor market can least absorb it. And sitting underneath every single one of these compounding pressures is a stock market that the New York Times has explicitly called a bubble. Propped up by AI valuations that ING's formal 2026 risk model says could trigger a full-blown recession if the underlying technology fails to monetize at the scale investors have already priced in. A collapse that would hit hardest, the exact retirement accounts millions of Americans are relying on to survive everything else happening around them. None of these dates were coordinated by any single actor with a master plan. That is what makes this more frightening, not less. Nobody sat in a room and orchestrated the convergence. It emerged from dozens of separate decisions, made in separate rooms by separate people, none of whom were required to ask what happens when all of their individual choices land on the same American household in the same 6 months. And they are landing, right now, on you. Whether the people who made these decisions ever calculated that convergence or not. When 2008 arrived, the government spent $1.8 trillion to stop the bleeding. When 2020 arrived, it spent $5 trillion. And when whatever is coming next arrives, the country's own fiscal watchdog has already told Washington in writing that it cannot afford to do either of those things again. You have almost certainly assumed, somewhere in the back of your mind, that if things get bad enough, the government will simply do what it did the last 2 times. Write the checks. Backstop the banks. Send the stimulus. Absorb the shock so the average family does not have to absorb it alone. That assumption is not just outdated. It has been formally, explicitly, publicly retired by the very institution whose job is to plan for exactly this scenario. In March 2026, the Committee for a Responsible Federal Budget, a nonpartisan fiscal watchdog founded in 1981 and staffed by former Congressional Budget Office directors and Treasury officials from both political parties, published a paper with a title that should be repeated on every news broadcast in the country and instead vanished into a PDF nobody outside Washington ever opened. Break Glass. A plan for the next economic shock, and its opening sentence stated, without hedging, that the United States has never experienced an economic shock as indebted as it is today. Not during the Civil War, not during the Great Depression, not during 2008, never. During the 2008 financial crisis, the federal government spent approximately $1.8 trillion on stimulus, bailouts, and stabilization, and it worked. In large part because the debt-to-GDP ratio at the time was roughly 64%, low enough that bond markets absorbed the new borrowing without demanding punishing interest rates in return. During the pandemic in 2020, the government spent approximately $5 trillion, and even at a debt-to-GDP ratio near 100%, the borrowing still worked, still got absorbed, still kept the collapse from becoming a depression. That ratio now sits at over 120%, the highest sustained level in American history, with annual interest payments on the existing debt having already crossed $1 trillion for the first time ever, consuming a larger share of the federal budget than the entire defense budget in some projections. And the CRFB's own modeling states plainly that a shock arriving on top of this debt burden renders the historical playbook unusable because you cannot simply borrow another $5 trillion when you already owe $39 trillion, and the interest alone is consuming $1 trillion a year, without triggering the exact kind of bond market panic that turns a manageable recession into an uncontrollable debt spiral. So the CRFB laid out, in writing in an official planning document, what the actual emergency response would look like instead. Freezing Social Security cost of living adjustments, freezing Medicare payment adjustments, freezing SNAP benefit increases, freezing discretionary spending across the board, raising taxes, implementing an emergency deficit reduction surtax. Every single item on that list is a cut, a freeze, or a tax increase, landing directly on the same population already absorbing every crisis in this video simultaneously, at the exact moment they will need help the most. There will be no stimulus check this time. There will be no rescue package waiting on the other side of the coming shock. The institution whose entire job is planning for exactly this moment has already told Washington, in writing, that when the next crisis hits, the response will not be relief. It will be austerity, delivered to a population with nothing left to absorb it. I am not going to end this video by telling you 3 things you can do to fix this, because nothing in this video was a problem you created, and nothing in it is a problem 3 tips can solve. I am ending it by telling you the one thing almost nobody will say out loud. You are not imagining how bad this feels, because it is actually this bad. For the entire length of this video, I have shown you reports from institutions that do not exaggerate for engagement, that do not need your view count, that publish in careful, hedged, bureaucratic language specifically designed to avoid alarming anyone. And every single one of them, independently, without coordinating with each other, arrived at the same conclusion using different words. The heating bill you cannot afford is the cheapest one you will ever pay again. The job market that looks stable is stable only because fewer people are counted as being in it. The health insurance you are relying on has already doubled, and the market underneath it is unwinding in a pattern health economists call, without irony, a death spiral. The retirement account you have not checked in months is concentrated in a bet that the New York Times has openly called a bubble. The Federal Reserve Chair, whose independence has protected your mortgage rate from political interference, loses his job in May, replaced by someone chosen specifically for his willingness to ignore that independence. The home you own may soon be uninsurable, unmortgageable, and unsellable, according to a congressional committee that used the words full-scale financial crisis without flinching. The safety net that was supposed to catch you was quietly scheduled to disappear across a dozen separate dates throughout this exact year, so that no single headline would ever capture the full scope of what happened. And the institution whose entire job is planning for the next economic shock has already told Washington, in an official published document, that when that shock arrives, there will be no rescue package waiting, only freezes, cuts, and tax increases, landing on a population that has already been drained by everything else in this list. I am not telling you this so you will subscribe, or share, or comment below with your fear, though you are welcome to do any of those things if it helps you feel less alone tonight. I am telling you this because you have spent months, maybe years, feeling a specific kind of dread that nobody around you seems to be naming out loud, wondering if you are the only one who senses that something underneath the surface of ordinary life has shifted, wondering if you are simply too anxious, too pessimistic, too unable to see the good news everyone else seems to be finding. You are not. The dread was never irrational. It was accurate. Every institution I have cited in this video, institutions with no incentive to scare you, institutions whose entire professional reputation depends on being right, rather than being dramatic, has confirmed in careful and controlled language that the floor beneath ordinary American life is genuinely, measurably, structurally giving way on a calendar that has already been set, in a convergence that has already been calculated, by people who will not personally feel any of it the way you and your family will. I will not lie to you and tell you there is a clean way out of a convergence this large. I am simply telling you what is coming, plainly, so that whatever happens next does not arrive disguised as a surprise,